And I guess that's the big question on everyone's minds right now. Are we going to retest the lows, so to speak?
Well, I think you're going to hear a lot about it, Kelly. And we came out with our note on Monday, quite frankly, and said that we believe that the stock market in the United States was going to rally 40 to 50% from the lows. I think we're on our way. And, we were accused of being Pollyanna and bullish all the time. But again, these are unprecedented times, unprecedented. And I think that we as investors have to expect unprecedented upside after this unprecedented irrational trading on the downside. What we're dealing with is data that we don't typically deal with as investors. We're trying to be closet and couch epidemiologists and doctors, and our personal lives are affecting our work lives. And we're bringing that emotion to what's happening with respect to markets. That's why we've written a lot about panic is not an investment strategy. That's why we look at longer term. And that's why we talk about our conviction is resolute. Our conviction is resolute on the companies in the United States of America because we think clearly they're the best companies in the world. Yes, we're going to have very negative news in the next quarter or so, but we can't control that. How can you, and what should you can control what you can control? Buy really good companies, high quality companies. We think the best high quality companies are here in the United States. That's why we believe the market has rallied back up, and that's why we think we have more to go. Whether or not we're going to retest, nobody, Kelly, nobody can predict the bottom, just like nobody absolutely predicted the top. That's why we want investors to stay invested in America.
So let me put it differently, and probably only have time for one more here. Are people risking a big capital loss by putting money into the stock market right now?
No, they're not. And you've seen a lot of tax loss selling already take place. What's really interesting is that, I learned the business 30 years ago from William O'Neill. He was my very first mentor. And he used to tell me that institutional money is the smart money and retail money is the dumb money, just to put it bluntly. And we're seeing retail money. My calls with high net worth people have been very calm and not a lot of anxiety because they're positioned accordingly and they have been taking tax losses. It's the institutional money, the fast money that's missed this, because they've been all one-sided, Kelly. So that's why it's so important to stick with the best companies from a longer-term perspective in sectors like communication services, technology, and discretionary to really take advantage of this rally.
So you'd stick with quality as opposed to the stuff that's hardest hit?
We would, because I think, again, if you go back to my experience back in 08, 09, you had the low-quality rally after the market bottom in March. You have to be careful. So stick with high quality and stick with the best companies.
Well, you let me sneak in a final one there, Brian. Thank you. I appreciate it. And it's good to see you,
today.
Brian Belski of BMO.